Have you ever wondered how a huge new factory gets built, or how a brilliant app idea gets the cash to actually become a reality? Well, the answer, more often than not, is hiding in the world of securities. So in this explainer, we're going to pull back the curtain on that complex market and break it all down into simple, powerful ideas. Let's dive in.
So before we get into the nuts and bolts, we really have to understand the core problem this whole system is built to solve. Think of it as a massive, two-sided puzzle, one that sits right at the heart of our entire economy. On one side of this puzzle, you've got these incredible, massive ambitions. I mean, think about it. A company planning a factory that could create thousands of jobs, or maybe an entrepreneur who has an app idea that could literally change how we live. Ventures like these need a huge amount of capital, way more than a simple bank loan can usually cover.
And then, on the other side of the puzzle, there's you and me, and millions of other people who have some savings tucked away. We don't want that money just sitting around, right? We want it to grow, to work for us, to build toward our future. So, what's the bridge? How do we connect our savings to those world-changing ideas?
Well, the solution is this really clever invention called a security. It is the magic ingredient, the bridge that connects both sides of our puzzle. So what is it? It's basically a formal, tradable IOU or piece of ownership. But the key words here are standardized and transferable. That just means they're all made to a certain standard, and you can easily sell them to someone else. It's the tool that lets money flow from people who have it to the people and companies who need it, all in a structured, organized way.
Okay, so if securities are the product, where do you go to buy and sell them? You need a market, right? But this isn't your local farmer's market.
We call this the securities market. Now, when I say that, don't picture some big stone building with people yelling and throwing paper around. Think of it more like a massive, interconnected system, a global marketplace. Its entire job is to be the most efficient matchmaker possible, connecting companies and governments that need money with millions of investors who are looking to put their savings to work.
And just like any good market, this one has different aisles with different kinds of products. In the securities market, the two main products offer you fundamentally different ways to participate. You can either be an owner or you can be a lender. So your two main choices really boil down to this. First, you can buy equity, like a stock. This means you're buying a small piece of the business itself. You become a part owner. Your fortune is tied to the company's success, which means you have the potential for high growth, but it's also higher risk. If the company gets into trouble, the owners are the last ones in line to get paid. On the other hand, you can buy debt, like a bond. Here, you're just acting as a lender. You give the company a loan and they promise to pay you back with a fixed interest payment. It's more predictable, and critically, lenders always get paid before owners. That lowers your risk.
And this right here gets to the fundamental trade-off of all investing. You have to ask yourself, are you aiming for big growth and are you willing to accept more risk to get a potentially much bigger reward? Well, that's the path of equity. Or do you care more about predictable, steady income and keeping your original capital safe? That's the role of debt. It all comes down to that core balance between risk and return. Okay, so we know what's for sale, equity and debt. But our marketplace analogy, it actually goes a little deeper. See, it's not just one big shop floor. There are really two distinct markets that work together to make the whole system go.
This is a really great way to understand it. First up, you have the primary market. Think of this as the grand opening. This is where a company creates and sells securities for the very first time, like in an IPO. Now, the crucial part is, the money raised here goes directly to the company to build that factory or develop that app. Then, everything after that happens in the secondary market. This is the resale floor. This is where you and I and everyone else trade those existing securities among ourselves. When you hear about the stock market on the news, that's what they're talking about. The company isn't part of these trades. The money just moves from one investor to another.
So here's the key point to remember. The primary market is all about capital formation. It's how companies get the cash they need to grow. The secondary market is all about liquidity, and liquidity is just a fancy word for how easily you can sell your investment and turn it back into cash. Without a healthy secondary market where you know you can sell, nobody would ever buy in the primary market in the first place. But it also does something else. The prices in the secondary market send a powerful signal about how healthy a company is, which in turn affects how easily it can raise money in the future. The two markets are in a constant conversation with each other.
Now, this giant marketplace doesn't just run itself. Of course not. There is a whole ecosystem of participants, and every single one has a critical role to play. So let's meet the cast of characters.
This breaks it down perfectly. First, you've got the issuers. These are the companies and governments that need the money. In our analogy, they're the shop owners creating the products. Then you have the investors. That's us. We're the shoppers with the savings. Connecting the two are the intermediaries, your brokers, your banks. They're the market staff who make all the transactions happen smoothly. And finally, watching over the entire operation, you have the regulators. They're like the market authorities, setting the rules of the game to make sure everything is fair and safe for everyone involved.
So, we've covered the what, the where, and the who. But that leaves the biggest question of all. Why? Why does any of this matter? Why is this system so absolutely vital to our modern world? Because this is so much more than just numbers flickering on a screen. The securities market is literally the engine of the economy. It's the system that takes all the savings sitting in millions of individual households and channels that money into productive investments that build our future. This is what fuels economic growth, creates jobs, and at the same time gives all of us a powerful platform to build our own wealth over time.
This quote really captures the entire essence of it. Through securities investment, individual savings of many households can be mobilized into generating productive capacity for the country. It's about taking small, scattered savings and combining them into a powerful force that can build infrastructure, fund new ideas, and drive real progress.
So there you have it, a powerful marketplace connecting big ideas with our savings, all built around that timeless balance of risk and return. We've looked at the machinery, we've met the players, and we've seen the incredible impact it has. The only question left is, now that you understand how the engine works, how will you use it to power your own financial future? Thanks for watching.